Another day and another former investment banking executive and investment banking trader charged with precious metals market manipulation. So I was searching for this in Zero Hedge. I was using two different search engines, both DuckDuckGo and Google, and this article didn't come up. However, the Reuters article came out on last week on November 15th from Ko Gui Ching and Lawrence Delving from Reuters. So the article, you can see most of it there on your screen. The Department of Justice has charged another former JP Morgan Chase & Company executive with alleged racketeering and manipulating precious metals prices between 2008 and 2016, the latest in a string of similar prosecutions. The indictment against Jeffrey Ruffo, who is also charged with other federal crimes, including conspiracy to commit wire fraud, is a result of an, quote, ongoing investigation, federal prosecutor said in a statement. This is interesting here. Ruffo is the sixth person to be charged with alleged fraud in connection to JP Morgan's precious metals desk. And that's just in the last year and a half, 2 years. Okay, the case relates to spoofing, and people have asked me about this. Spoofing, precious metals market spoofing is just the tip of the iceberg. I'll talk about some of the other stuff in a little bit. There's a very incestuous relationship, at least in the past. I'm not as sure now, but a lot of the stuff was in the past with Gary Gensler, who Ted Butler was wrong about. Being from Goldman Sachs, he became the head of Hillary Clinton's 2016. He was her campaign finance manager. And there was a revolving door for the people, the lawyers and investigators at the CFTC who were in charge of the precious metal market manipulation, the silver manipulation case for 5 years. They quit that job and they ended up defending now. Their law firm is defending some of these JP Morgan bankers that are on trial. It's all incestuous. It's incestuous. It's all a revolving door. I mean, Andrew Maguire wasn't able to even testify at the hearing. It was if you're familiar with what actually happened at the hearing, I almost went since I live not too far away, but I logged in and I was trying to listen to the live stream and they shut down the audio. So anyway, the article is really short. Let me go back to it. Case relates to spoofing, which involves placing bids to buy or offers to sell contracts with the intent to cancel them before execution, allowing spoofers to influence prices. So this is painting the tape. They're painting the tape, except they're pulling away orders. They're fooling people. Also, what they do, they have the investment banks, the bullion banks, have access to all your margin accounts. So if you're a small futures trader for gold and silver contracts and you have a margin account and you don't have that much money, they can see how much of your trades are on margin and they know where your stops are. So they blow out stops routinely. They can program this in. They're given access to unfair advantages with trading. They can see the order books. So there's tons of other examples of the entire gold and silver market, the paper market. There's been fines in the past. My buddy Dave Kranzler, he wrote an article in, let me see if I have it up here. It's 2014. I looked it up for you guys. August 4th, 2014. My friend Dave Kranzler for Investment Research Dynamics wrote, the CFTC Commodities Future Trading Commission commitment of trader data is all rigged. So JP Morgan was fined heavily in 2014 for fraudulent commitment of traders data. I'll read that article in a little bit. Let me finish the Reuters one. So allowing spoofers to influence prices. In recent years, there has been a surge in spoofing-related prosecutions in the United States by the Department of Justice and the Commodities Future Trading Commission. So, like I said, spoofing is only the tip of the iceberg. There's a lot more fraud and shenanigans. It's involving GLD, the supposed physical gold trust, which is not really. If you read the prospectus, there's a ton of loopholes. My buddy Trace Meyer, before he ever bought a single Bitcoin, he actually and he invested in gold and silver, and he had run to gold, and he wrote a book called The Great Credit Contraction. He also had a website, howtovanish.com. I don't think he's into gold anymore, really. He doesn't like talking about gold in any of his interviews or when I speak to him in emails. I don't know if he owns any more physical gold. he's made a lot of money speculating on Bitcoin. He was one of the first people to publicly recommend going into a lot of it. I think he was in way under $1. I think he was in under 30 cents in Bitcoin. Anyway, he put this video out because he is a lawyer and he cared about the gold market in May 1st, 2009, this YouTube video on, and I don't think he cares about it that much anymore. His YouTube video has over 10,000 views, and he goes through the prospectus. So I'll attach a link to that video. If you're not familiar with it, it's on his Run to Gold YouTube channel. And you could take a look there, and he shows you the issues in the GLD prospectus. And speaking of which, Dave Kranzler is out with another article. Him and Craig Hemke of the TF Metals Report did some sleuthing, some investigating that the CME group may have helped HSBC out on the COMEX. And one of those things with the shenanigans, the allowed fraud that happens is the different categories. There's always, I would say, overestimates of how much metal is in the warehouses, especially for silver. I've heard stories anecdotally of friends in the past, money managers who literally ordered a ton of physical silver for delivery, and the metal should have been there in the vault, in the COMEX vaults, and they had to wait more than 6 months for delivery. This was in 2009. So should have easily gotten delivery, was told that there was supposedly plenty of metal in the vault and it had to wait 6 months for delivery. It's all part of the scam. Paper price manipulation, managed retreat. It's really sad. This is a new normal, unfortunately. Okay, so back to the article. Ruffo could not immediately be reached for comment. Of course not. He's going to speak to his lawyers. His lawyers are probably used to work at the CFTC now. A JP Morgan spokesman did not immediately respond to a request for a comment. The U.S. bank, you think I'm joking, used to work for the CFTC. I've looked through lawyers in this area, and a lot of them used to be former regulators. So they go from knowing the loopholes at regulatory agencies to helping corporations get out of trouble. It's pretty funny like that, unfortunately. It's sad and funny at the same time. I would rather laugh than cry. A JP Morgan spokesman did not immediately respond to a request for a comment. The U.S. bank has said in recent regulatory filings that it is cooperating with various investigations relating to its metal trading practices. According to the indictment, Ruffo worked at JP Morgan from 2008 to 2017 as a salesperson serving hedge funds investing in precious metals, and he encouraged JP Morgan traders to place deceptive orders to create price advantages for his clients. The indictment also alleges that Ruffo and his former colleagues defrauded JP Morgan's clients who had invested in, quote, barrier options by pushing option prices to levels that benefited the bank. JP Morgan's been fined for all kinds of derivatives trades, all kinds of manipulations in the derivatives markets, commodities markets, etc. A lot of these other investment banks too. An option is a financial instrument that gives buyers the right to buy or sell an underlying asset at an agreed upon price and at a fixed time. Its value is tied to the value of the asset, while previous spoofing prosecutions have led to guilty pleas. Recently, a former metals trader at Swiss bank UBS Group was actually acquitted by a jury in a similar case last year. The acquittal highlighted the difficulties in making a case that canceling orders is a criminal act, given that many market orders go unfulfilled. That actually is a halfway decent defense, but so is painting the tape. So I guess the prosecutors didn't do a good job of showing painting the tape, manipulating the market. They didn't do a good job of that. Some lawyers also argue it is aggressive to charge bank executives with a racketeering conspiracy, which is usually associated with organized crime. The charges were filed on Thursday of last week and made public on Friday. So this is now half a dozen alone JP Morgan metals traders or executives at JP Morgan in charge of metals trading charged in the last year and a half, 2 years. Gold price is actually holding up okay for now. It's not back at 1,500. It's at $1,472. Silver's back over 17 at $17.12. The mining companies are starting to raise small amounts of capital. It's kind of a panic. They're kind of worried. They're not able to raise large amounts of capital. I've stated many times who I think this will benefit if the miners cannot raise capital. I did an entire video lecture on this, on who benefits from paper price manipulation the most in the gold and silver industry. And yes, there is paper price manipulation for gold and silver. It is well documented. They cannot cap the price. They cannot cap gold at 1,000. They cannot cap silver at 14 or 15. It would create immense shortages eventually. The miners would go bankrupt. And no, I do not agree with Bob Moriarty. I'm getting emails what I think about Bob Moriarty in his article. I spoke with my buddy Peter Spina at GoldSeek. He's been covering the gold market for about 20 years. He put up one of the first gold websites ever. And Peter said that Bob Moriarty of 321 Gold has been he's been against gold and silver manipulation, saying it's not a big deal or it doesn't matter. And that would actually reduce demand for gold and silver. So he's been saying this for 20 years. This is a good question by Sonny. Which is manipulated more, the VIX or gold? That's a tough question. It's a very tough question. I mean, they're both manipulated a lot. I'll have to think about that one more. I mean, they're both manipulated a lot. It might be a tie. Almost everything's manipulated now in one way or another. I mean, you have Trump tweeting out stuff to try to move the market higher, lying about trade deal progress. There is no trade deal progress. He's been lying about it Monday through Friday, every day for over a year. The only time there was legitimate trade deal progress was that 150-page agreement that Bob Lighthizer and Kyle Bass have been talking about, and then 50 pages wanted to be removed at the last minute, anything that the Chinese would have to sign and be enforceable. Aggregator says the miners were hit hard today, along with the typical morning attack. Yeah, and the mining companies are too scared to speak out. The only mining CEO I know who speaks out is Keith Neumeyer. All the other ones are too scared. Off the record, I've had conversations with some of these mining CEOs, and yeah, they'll admit that there is manipulation in gold and silver. They're too scared to speak out against it. Another part of the manipulation scheme that's sophisticated is GLD. There is not a lot of physical metal that goes into GLD. I don't trust the numbers. There's no real independent audits. The prospectus, there's a loophole that can be driven through. If you watch the Trace Meyer video that he made in 2009, it's only 5 minutes long. 10,000 views on it. It's runtogold.com examines the GLD prospectus if you want to watch it later. I'll put it also at the end of this video. So let me read the Dave Kranzler story from 2014, August 2014. Dave Kranzler and a few others, primarily the Gold Antitrust Action Committee, which has done an incredible job well documenting gold and silver prices, although paper price manipulation of gold and silver, although their predictions for gold and silver prices have not been good, have been suggesting for quite some time that contract open interest data the CME group reports for the COMEX is rigged, while certain newsletter peddlers adamantly maintain the reports are accurate and honest in order to preserve their franchise. There's nothing like the CFTC imposing a fine on JP Morgan for fraudulently reporting large trader data. And this was they were fined, let's see, they were fined. Is it a pro? Okay, 1 second, I'm opening up this other link. They were fined on July 29th, 2014. They violated laws, over $650,000 civil monetary penalty, and some other fines. Which is, a slap on the wrist. considering they can make billions manipulating. Look how much gold was sold in only 30 minutes, like way more than the annual production in an entire year of paper gold futures contracts like 2 weeks ago. JP Morgan has finally been caught and sanctioned for playing games with its position reporting in gold and silver in order to hide the true magnitude of its unhedged short positions on the COMEX. JP Morgan does this is obvious to anyone who has spent several years studying and trading the COMEX. After all, how are CFTC COT reports compiled? They come from big banks who are the primary COMEX market makers. There's no independent audit of the numbers. The reports are sourced from the banks, then submitted to the Chicago Mercantile Exchange and the CFTC. It's a, quote, trust us job, wink, wink. Anyone who chooses to believe otherwise either has ulterior motives, like making a lot of money selling newsletters, or still believes in Santa Claus. While the COT report still holds some small degree of validity in terms of showing us what was happening a week ago on the COMEX, Dave Kranzler believes that the COT is now largely useless for the purposes of making money on the information. First and foremost, the numbers are to some degree fraudulent. Second reason is that the information content for trading purposes has lost value. 10 years only a few crazy gold bugs looked at the COT report 10 years ago. I guess there's a typo in here. Only a few crazy gold bugs looked at the COT reports and used them to trade. Back then, the informational content had market value as a source of informational inefficiency, derived from the fact that so few people were spending little money, relative basis, using the information to trade. Now, everyone under the sun follows the precious metals markets, looks at the COT reports, and incorporates the information conveyed into their trading strategies and investment outlook. Because there's so many eyeballs and a lot more money involved, it can be said that the market has become more efficient with respect to the information. Any informational edge that used to be offered from analyzing the COT commitment of traders is no longer available, in his opinion. And in his recent article that he put out yesterday, a couple days after the Chicago Mercantile Exchange allowed clearing members to use warehouse warrants as collateral for the mandatory performance bond, the new form of collateral was implemented by HSBC Bank. If you're not familiar with HSBC Bank, they are the custodian of GLD. Also potentially involved in a lot of other nefarious things in Hong Kong, and also with the potentially the Chinese government and the People's Bank of China. And they have a really dubious history as well. I think it even goes back to the Opium Wars, someone was telling me. With help from Craig Hemke, it appears, whose TF Metals report, it appears as that the COMEX activated a low-grade rescue of HSBC. Chris Powell at GATA, Gold Antitrust Action Committee, believes this hypothesis fits the decades-long practice of the international gold price suppression scheme of governments, central banks, and bullion banks, that is to keep metal moving around so fast that it can be applied to pressure points before its real owners notice that it's missing, to make a single ounce of gold seem to be in as many as 100 places at once. So the physical metal is moved around by the banks to put out fires, so when people ask for metal, the banks can move other people's metal that's supposed to be segregated or in people's like vaults. Remember, there's been tons of fines over the years. I believe Morgan Stanley paid enormous amounts of fines because they sold silver, physical silver, a lot of it that was this was like in the last 7 or 8 years, that was supposedly in separate vaults for customers, and they sold it. And then the customers found out, and the silver that was replaced wasn't the same bar numbers, and then they sued. This is a very sophisticated scheme. It's been since the gold and silver's futures contracts were started, it's been getting more and more sophisticated. Okay, back to the article. On November 4th, authorization for traders on the New York Commodities Exchange to use London Gold and COMEX Gold warrants as collateral was tripled, raised from $250 million to $750 million. HSBC now has used $340 million, or 45.43% of its new collateral limit. It seems more than coincidental that HSBC took advantage of the collateral increase so soon after it was put into effect. Dave Kranzler sees the rules change as a low-grade bailout of HSBC, analogous to the Fed's low-grade bailout of the big banks with repo. And yeah, with repo, the rule change also flags HSBC as the largest trader in the commitment of trader category that designates the percentage of the long and short contracts held by the 4 largest traders on the COMEX. So HSBC claims when they're buying physical gold for GLD, I believe that they claim that they hedge to give them the ability to buy cheaper physical gold at lower prices. They sell futures contracts. I believe that's what they claim. They've claimed that over the past. And also, you know, in the past with position limits and hedging strategies, the claim has been that there's commercial hedgers, that the mining companies are hedging their gold and silver prices. Yeah, like miners would hedge gold and silver prices when gold was below 1,200 and silver was at below 15. The miners would not hedge then because a lot of the miners were close to bankruptcy. Assuming as is likely, okay, back to the article. Assuming as is likely, HSBC short position was largely put on at a lower gold prices. The bank is probably getting hammered with a mark-to-market loss. Here's the issue that needs to be answered, but likely never will be. Do any of the warrants HSBC has pledged as collateral involve gold not owned by HSBC Bank? In the opinion of Dave Kranzler, all of the gold in these warrants is not really owned by the bank. Most likely, HSBC is using for collateral purposes gold that does not belong to the bank. Customer gold. That is outright hypothecation. Yep. I wonder, isn't that also what MF Global did? I wonder if the agreement signed for people that had gold and silver stored in MF Global, I wonder if the agreement signed by the vault operators allows them to hypothecate gold held in the vault and not owned by the bank. So they're pledging assets owned by the customers, not supposed to be commingled, pledging it as collateral for other bets or other stuff. Now here's when it gets even more interesting. Assume HSBC is short these warrants pledged as performance bond collateral and the price of gold moves a lot higher. Then HSBC is getting killed technically. Being short gold collateral, it has pledged for its own liability but doesn't own. How does the bank remedy this? It uses an exchange for physical or privately negotiated transaction using London Gold. Since HSBC is the vault operator for the major gold exchange trade fund, GLD, they're the custodian, like I said. This London Gold EFP PNT, that's a different type of gold instrument. What is it? I think it's abbreviated from what was earlier in the article. Would likely use GLD vault gold that may or may not have been hypothecated. HSBC is likely getting financially squeezed to a major extent on its COMEX future short position, and the CME bailed it out by changing the collateral and performance bond margin rules. So this goes back to rule number 1. When the banks are in trouble, the rules get changed. When the governments are in trouble, the rules get changed. The large governments. When the banks are in trouble, the rules get changed. Welcome to dystopia. Yeah, Anthony, I remember you asked about this last time. Spoofing is only the tip of the iceberg. It's very sophisticated. It would probably, in detail, it would probably take someone a couple hours to explain it all. It involves GLD. It involves bad data reporting in the commitment of traders. The banks are almost always, the bullion banks are almost always over-reporting how much physical metal is at the COMEX. I've heard there was anecdotal stories in 2011 when silver was really ripping higher that people were being offered 80% cash premiums, futures contract holders, to not demand delivery, to not take delivery. There's articles about that from 2011. You can go back and search them. That they were offering immense amounts of extra cash if people would not ask for a delivery of the silver. And if they insisted on delivery of the silver, they were told, okay, you're going to have to wait a while. Like I said, I know someone who took delivery of a ton of physical silver, literally a ton. And that much metal should have been in the vault, and he was told he had to wait 6 months. And I think it took him longer than 6 months to get to the delivery. That was Jim Poplava of Financial Sense NewsHour. He's talked about this years ago. I don't think he talks about it that much anymore. IBGI says, and they charge storage fees for the silver that they sold. Yes, Morgan Stanley was charging customer storage fees, and they had sold the silver. Yep. That's why they got fined. And I believe there was other large banks doing that too. I forget the other ones. But I know Morgan Stanley, there was a class action lawsuit, there was fines. Most people don't care about that anymore because that bank is so big. People in the gold community care, and silver community care. That's about it. You wonder how much physical metal fraudsters actually own. A lot of people on Wall Street actually own a lot of physical gold and silver. They just don't go on TV on Bloomberg or CNBC and talk about it. And I've heard from former floor traders. I've spoken with Greg Manarino about this. Greg Manarino used to trade on the trading floor, and he said his trading floor buddies would openly discuss that gold and silver was manipulated. They would see the paper price smash orders come in, and they would piggyback that trade. And some of these floor traders, they would hop on to the manipulation trades, and then they'd buy physical metal with the trading profits. Albert says pledged gold went from only 100 ounces to 200,000 ounces. Yeah, it's a big jump. More rules changes, more moving the goalposts. Rule number 1. They can't move paper gold and silver too much lower, though, because the miners are going to be back in trouble again. And then that means there'll be less physical metal for delivery. There's already problems long term with maintaining the current production levels for gold and silver. Hello? Can you guys still hear me? Well, I've talked about this in the past. The rules got changed on the Hunt brothers. The Hunt brothers were billionaires too. So the average little guy doesn't have a lot of shot trading on with the futures contracts. Look, the Hunt brothers were billionaires. They weren't part of the globalist club. They were America first. If you go, there's YouTube documentaries about the Hunt brothers. Go watch the Hunt brothers. The Hunt brothers were billionaires. Now, the major mistake the Hunt brothers did was they got greedy and they started playing in the futures market on margin. That was the mistake. If the Hunt brothers had just stuck to buying physical silver, accumulating it without using futures contracts with margin, and just opened up their silver mine, they would have been all right. They leveraged to the hilt with extra margin, and then the rules got changed on them. There was selling only days. There was no, the exchanges screwed over. They did the Hunt brothers so dirty. They changed the rules. There was no buying allowed. People are not aware of this. They leave this out of Wikipedia. They leave this out of books. They literally shut down the exchanges to screw the Hunt brothers over. No, margin was the mistake too, because they had enormous margin calls. It was both. They got sued an insane amount. They don't talk about this anywhere, really. But the buying got shut down. They had liquidation only. Jim Sinclair was one of the few people alive who still... there's very few people alive who were involved in this. Who were involved directly in this. Who are still alive. With the Hunt brothers. And there was forced selling only liquidation days. So if they can screw over the Hunt brothers, and the Hunt brothers are billionaires, and they can hire the best lawyers, the best tax accountants, the best tax attorneys, best lobbyists, the average guy doesn't have much of a prayer playing in the futures market. Margin was one of the two mistakes were using way too much margin with greed because they owed a lot on the margin. That's another rules change. The pledge, in my opinion, I haven't studied this pledge gold stuff immensely, but I think it means that they just don't have a lot of physical metal. Normally when they're moving metal around like this, it means there's shortages. So if they're taking gold out of other people's hands, or gold where it's supposed to be in one place and moving it to another, that means that there's shortages. That there's a lot of demand for physical gold from central banks, which are net buyers, especially in Eastern Europe and China. And now we know that billionaires who had never bought gold before are also buying. Dan says China and Russia are black holes for gold. Yeah, I agree. They really don't like gold leaving the country. Gold money allows independent auditing, Anthony. And you could take immediate delivery of your metal. They don't have loopholes like the GLD and SLV prospectus. The GLD prospectus is nuts. All the loopholes in there. Okay, well, that's it for this short show. I got one super chat from Justin. Thank you. And thank you to my almost 200 Patreon account contributors. If you want to read more articles about this, I will put them in the information and description section. So the 2014 article that Dave Kranzler at Investment Research Dynamics wrote about the CFTC fining JP Morgan for false, fraudulent commitment of trader data. And the new article Dave Kranzler has out about CME pledged gold now. Looks like more rules changes. They're going to keep changing the rules. All the rules are going to get changed. Like they've already gotten, they're getting rid of LIBOR. I don't even know what they're replacing it with something weird. But that's because everyone remembers how LIBOR was manipulated, so they have to change the name of it so they can, do something else, more games with it. Okay, that's it for right now. Thank you very much to my almost 200 Patreon account contributors, my dozen or so monthly PayPal contributors, and the people who tip me once in a while.